When it's time to look at investing, we need to address which asset class to invest in. 95% of people don't understand the concept of asset allocation and believe holding onto stocks for the long term is a sufficient means of wealth appreciation. Despite the history to prove otherwise, diversification is considered to be rather humorous, yet still silently victorious. You came here for the truth, so let me unveil that for you. Today we're going to look at the only safe haven left. That's right, when you look at the stock markets, where should you turn? Well, very clear to me. You could see the Nasdaq has been skyrocketing recently, and this has been quite evident throughout 2018 specifically. While other stock markets have not been able to move up, the world stocks have truly been lagging behind the Nasdaq. Now, this reminds me a lot of the year 2000, but it's different this time, they say. So we'll address that today. You can see the S&P and the Dow versus the Nasdaq clearly having this major divergence in between the two. So we'll go into that more. You could see specifically the Fang Stocks have risen here throughout July so far. It has come up, and this has been yet another record. And this is generally where people have been investing their money, in the Fang Plus stocks. So that is Microsoft and so on. There are other stocks here, and I don't know if they're necessarily including the plus in this chart. However, I'll tell you right now, the Fang Plus stocks have been doing extremely well. So this is an index that people have been looking at to suggest the market is doing well. But as I've outlined many times before, it isn't the market that's doing well. It is only a handful of stocks. In fact, I think it was 4 stocks account for 84% of the total, and that's only going to get worse as time goes on. You could see with interest rates at the bottom, it has completely dislocated and disoriented the market, and reality is not present today. But that's not a problem for most people. They're looking for quote-unquote profit. So they put their money where the stocks have been rising. They don't look for value. They don't look for the potential of, based on any fundamentals. What they do is they say, okay, this stock has been rising, therefore I will buy it. And then it appreciates further and further and further. And they are made to be geniuses. But it's not really like that. I mean, you can even see what's happening with Berkshire Hathaway since January. It has not been past its previous high, but we are talking about supposedly what some consider to be the most intelligent investor in the world, Warren Buffett, and yet Berkshire Hathaway owning several companies that hasn't been able to surpass its high. Why? Well, because the market is focused onto just a few stocks, just a few. And it is very frightening to see this type of thing because you know that the top is forming. Here's the Nasdaq versus the 30-year yield, showing us where this has gone. The Nasdaq, if I'm not mistaken, took a whole 14 years to go back to its previous high in 2000. So after 2000, it spiked up. Everybody knows that. It went literally through the roof, crashed down very, very quickly, and then didn't even make it to its previous highs during the financial crisis. It came down here and has since surpassed it. So it took, however, up until that point, whenever it was a 14-year timeline. And that's what a lot of people are not aware of, because they say this company is so important that I don't need to necessarily worry about it because I know that if the stocks crash, I'll be able to recoup my losses. But in this case here, the most recent example, we had a time frame in which it took 14 years. Adjusted for inflation, I would suggest to you it's much worse. And of course, we have the Smart Money Flow Index, which I've shown you what that means before. heading down continuously. That's heading down continuously, yet we can see the NASDAQ, specifically the Fang Stocks, heading upward. Bond giants bet $100 billion on growth, and it hasn't paid off. Further along in this Bloomberg article, you can see a couple charts I'll show you. Bold bets. These are the bond funds with the most aggressive wagers on growth. So whether it's Templeton or Goldman or so on, we can see that there are definite problems that are being experienced. They're going for growth, they're not getting it. Why? We're seeing growth. We're being told that the stock market is doing well. We are seeing growth around the world. We are seeing some little issues out there, but nothing to worry about. There's no recession in the near future. But what's happening? Take every single asset class out there. Take all the different sectors. Take everything and actually address it. Actually have the audacity to look at the truth, and you'll see what I'm talking about. The luminaries of high finance have staked more than $100 billion in one of the boldest bond bets of the post-crisis era, that a global economy firing on all cylinders would spur government yields in the West and boost emerging market credits. It's going to go on to talk about it, but essentially what I want to suggest to you is that the market doesn't look at this as a safe haven as much anymore. The markets are basically showing complete weakness, and everybody is dumping their money into the Fang Plus stocks. A lot of people don't see a problem with that because they have 7 shares of Amazon, and that is, of course, their savings, and they're holding it in the form of equities. And I don't blame you, because you're not going to get any money holding it in cash. You're not going to get any interest. So you hold it in 7 shares of Amazon. Now this right here presents itself with an issue on the way down, because those are usually the ones that they take profit from first. So they are going to highlight the same issue that we did back in 2007, where you could see that tech stocks were the last ones to rise. A lot of people continuously, every time I bring this up, there is a suggestion that, look, that was the year 2000. These technology stocks weren't as pervasive as they are today. Technology is so much more important today. And yes, I understand. But look at what happened in 2007, and you can understand exactly what's going on. And that is fewer and fewer and fewer and fewer stocks seeing the benefits of quantitative easing. And eventually there's a trigger somewhere, somehow, and then the stocks come down. Not because that there's a bubble. Bubbles can form everywhere. We have the quantitative easing. We know what happened. We know how we got here. Eventually there's a trigger. It sends the market down. And these stocks are directly at risk because they've come up so much. People start selling. They think, oh, I've made all my profit. I can sell now. And they take their profits. Some of them do anyway. A bunch of other people just carry it all the way to the bottom. I'm going to go through this few charts here very quickly, and this connects in with the real economy. So we have stocks, which does not address the real economy. We have the unemployment rate, the U3, provided by the Bureau of Labor Statistics. That's not the real economy. That's fake. You could look at many different other statistics for that. The civilian labor force participation rate. Of course, we have so many others. But anyway, cumulative growth in population, 16 and over, versus employment, January 2009 to the present. Total increase in the population. Okay, you'll see that there on the left-hand side. Total increase in employment, and then the missing millions. What happened? What's going on here? Well, of course, that's the gap. That's what's not being addressed. There are so many people right now out of the labor force. How do we skew the numbers? Well, number one, you use the U3 statistic, and that pushes the individuals who are looking for work for longer than a year off the stats, right? Then you also have people doing temporary work. They keep getting hired, they keep getting fired, they keep getting hired, they keep getting fired. If you were to total up all of the jobs that have been quote unquote created since the March 2009, it would probably be like something ridiculous, like 1 billion or something. Like It's unbelievable how many jobs have been created since 2009. It's the same people over and over and over again. They get hired, they get fired. A lot of them are government workers on temporary contracts. They work for a month, get fired, and that's just the way it is. Oh, we need you back next month. Okay, we need you back next month. And that number doesn't ever sort of disappear. I mean, it is a job being created, but that person lost a job before. It's a joke. Full-time employees relative to the working age population versus jobless claims. And this is funny because every time this occurs, we have a recession that follows just after. This is the red dotted line, what I'm looking at, the 4-week moving average of initial claims. And this right here has actually surpassed the previous instances, and it is one indicator of a recession. Just because it happens doesn't mean that it's going to be any necessary issue here. However, when this happens, we tend to see recessions. In the past few times, in fact, this has occurred. Doesn't mean that it will. It just shows me that we have some reason to worry, and yet another indicator. 25 to 54 employment as a percentage of 25 to 54 labor force. We're at the same level that we were back in 1988. That's the numbers being completely skewed. It's unbelievable to see what's happening with employment, and the truth somehow still remains shrouded in mystery, even though it's very clear. Those not in the labor force soars since the year 2000, something I've showed you before, looking at where it should be, and yet it's just ridiculous today. Yes, I mean, it's not so black and white, but I think it's pretty obvious that the economy isn't doing well. Maybe you could argue to me that it is better today than it was, let's say, 2 years ago. Maybe, but it's so far gone. And with central banks around, it's never going to be okay because their intention is to ensure that mankind is enslaved. Oops, not allowed to talk about that. Real average hourly wage growth remains non-existent. I don't know about you, but whenever I talk to individuals looking at their hourly wages, they're not keeping up with inflation. The amount that we pay for our energy prices, whether that's electricity or anything else, continues to rise. Look at where it was 10 years ago. Look at it today. Look at food prices, despite what some individuals say. Food prices clearly have risen. There's no doubt about that. Sure, you can have low quality food. I'm sure there's a lot of options in the low quality foods where you put a bunch of... Anyway, won't go there. Lower quality food can get cheaper and cheaper, that's for sure. Soylent Green probably wouldn't be that expensive. Anyway, that's all for this video. If you found this informative, please give me a thumbs up. Your thumbs up is how you could support this channel. Comment down below to support this channel. Hit that subscribe button and join the, what are we at, 117,000 people at this time of recording. Please hit that subscribe button. Join the rest of us. This is a very good group. All around the world, so many knowledgeable people coming together on this one channel. So I want to say hello to everybody who's new here. And if you found the video informative, I know you'll find my books even more informative. If you want the financial education you were not taught in schools, these 2 books have it all. You can actually flip through these books. All you need to do is go over to Amazon. There's a link in the description, and it will allow you to flip through the pages of these books. If you're more interested in the audiobook version, you can actually get that at themoneygps.com.